This is a cryptocurrency dictionary, a collection of over 100 topics that, once explored, will provide you with a comprehensive understanding of the conversations taking place in the world of cryptocurrencies. This material will explain all the most important phrases used in the cryptocurrency world. Everything you need to know to stay safe. We will start in alphabetical order with airdrops. An airdrop is like a free giveaway of cryptocurrencies, distributed by a company or project. Sometimes it serves as a promotional strategy, and at other times it's a reward for dedicated users. To receive an airdrop, users need to meet specific requirements, such as owning a certain number of coins from another cryptocurrency, filling out a registration form, or completing tasks designated by the project creator. Example: one of the popular airdrops that gained recognition worldwide was conducted by the cryptocurrency project Arbitrum. In this airdrop, users who participated in activities on the Arbitrum test network before it became a fully operational standalone project were rewarded with valuable Arbitrum tokens. On several occasions, the airdrop's value reached several $1,000s. Accumulation refers to the process of gathering and holding a specific cryptocurrency for a certain period, with the hope of its value increasing in the future. It's an investment strategy where investors buy the cryptocurrency at a low price and hold on to it, anticipating its value to rise. Example: Investor X engages in the practice of accumulating Bitcoin by purchasing it at regular intervals when its price is low and holding on to it until the price increases. As a result, when the price of Bitcoin rises, Investor X can sell their Bitcoins at a profit. Allocation. In the context of launchpads, allocation refers to the process of assigning a specific number of tokens of a newly introduced cryptocurrency, for example, through an initial coin offering or an initial exchange offering. Allocation is typically based on a lottery mechanism or other criteria, where participants must meet specific requirements, such as owning a certain number of coins of the given cryptocurrency or filling out a registration form to have a chance at receiving the allocated tokens. Example: Company XYZ is introducing a new cryptocurrency to the market and offering it through an initial exchange offering on a launchpad platform. To participate in the IEO, users must possess a specific number of tokens from the Launchpad platform and register for the IEO process. Upon registration, Company XYZ allocates a specific number of tokens of the new cryptocurrency to individuals who met the allocation criteria. Altcoin. Altcoin is a term used to describe all cryptocurrencies other than Bitcoin. Altcoin is short for alternative coin, indicating that these are alternative cryptocurrencies to Bitcoin. Many altcoins have been created with the aim of improving or solving certain issues that arise in the case of Bitcoin. Example: Ethereum is often regarded as one of the most well-known altcoins. It was created as a platform for building decentralized applications and smart contracts, setting it apart from Bitcoin, which was developed as an alternative to traditional financial systems. Currently, there's a debate in many circles about whether Ethereum, given its popularity, should still be considered an altcoin. This ebook was created at a time when ETH holds the second position in market capitalization, right after BTC. There's an increasing discussion that ETH might eventually take the lead in this classification. Nevertheless, at this moment, Ethereum, like all other cryptocurrencies, remains an altcoin in comparison to BTC. AML. AML stands for anti-money laundering, which means preventing money laundering. In the context of cryptocurrencies, AML refers to a set of procedures and techniques used to prevent and combat money laundering and other illegal activities, such as financial crimes and terrorism involving cryptocurrencies. Example: Many cryptocurrency exchanges are implementing AML requirements, including the need to provide personal information and undergo identity verification to ensure that users are not engaging in illegal activities. Furthermore, some countries are enacting legal regulations related to AML concerning cryptocurrencies to ensure safety and transparency within this industry. Angel investor. An angel investor is a term used in investing, referring to an individual or a group of people who invest their money in the early stages of development of startups or young companies in exchange for equity in them. Example: many new cryptocurrency projects start as initial coin offerings, essentially as cryptocurrency startups accessible to almost anyone. Angel investors are often among the first to invest in these projects, believing in their potential and aiming to achieve high returns in the future. Fundamental analysis. Fundamental analysis in cryptocurrencies operates on the same principle as fundamental analysis in stocks or other financial instruments. Its aim is to evaluate the actual value of a cryptocurrency based on its economic and technical aspects. In the case of cryptocurrencies, this analysis includes factors such as adoption level. The more people use a specific cryptocurrency, the more valuable it becomes. Use case. Cryptocurrencies utilized for real transactions or services are generally more valuable than those simply held as investments. Technology. Cryptocurrencies built on advanced and secure technologies are more valued than those that are less developed or susceptible to attacks. Resources. For cryptocurrencies based on resources, such as commodities-backed cryptocurrencies, their value can be highly dependent on the prices of these resources. Risk. Investing in cryptocurrencies involves a certain level of risk, which needs to be considered when evaluating their value. Fundamental analysis in cryptocurrencies enables investors to better understand the actual worth of a given cryptocurrency and make more informed investment decisions. However, it's important to remember that the cryptocurrency market is highly volatile, and cryptocurrency values can change rapidly. Therefore, investment decisions should be made cautiously, and it's essential to regularly monitor the market conditions. Example. An example of a cryptocurrency that can be evaluated using fundamental analysis is Bitcoin. Here are a few factors to consider when conducting fundamental analysis on BTC. Adoption level. Bitcoin is the most popular cryptocurrency globally, resulting in a high adoption rate. The more people use Bitcoin, the more valuable it becomes. Use case. Bitcoin is utilized for real transactions, such as online shopping, payments for services, and more. Its application extends beyond just being an investment. Technology. Bitcoin relies on advanced blockchain technology, which is secure and difficult to hack. This increases its value. Resources. Resources are not a significant factor in evaluating Bitcoin's value, as it is a digital cryptocurrency not tied to any physical resources. Bitcoin, along with other digital currencies like Ethereum and Litecoin, is created through a process called mining, which involves using computational power to solve complex mathematical problems. Miners are rewarded with new coins for their efforts. Risk. Investing in Bitcoin comes with a certain level of risk, such as price volatility, the risk of losing private keys, or regulatory risks. These factors should be taken into account when assessing its value. Based on these and other factors, an investor can evaluate the real value of Bitcoin and better understand whether it is higher or lower than its market price. Technical analysis. Technical analysis in cryptocurrencies is a method of assessing the value of cryptocurrencies based on the analysis of price charts and other historical data, such as trading volume or highest and lowest prices. The goal of technical analysis is to predict future price changes of cryptocurrencies based on their past behavior. Technical analysis utilizes various tools such as technical indicators, price patterns, and trend lines to assist investors in identifying buy or sell signals. Some popular technical indicators that can be used in cryptocurrency technical analysis include the Relative Strength Index, RSI, and the Moving Average Convergence Divergence Indicator. Technical analysis is especially popular among investors seeking short-term or medium-term investments. However, it's essential to note that technical analysis does not account for fundamental factors such as profits, revenues, or a company's debt level. Its effectiveness might be limited during significant market changes or significant events that could impact cryptocurrency prices. Therefore, some investors opt to use both methods of analysis, fundamental and technical, to gain a more comprehensive view of the market situation. Example. Here are a few examples of how technical analysis can be applied to evaluate Bitcoin. Trend lines. Investors can mark Bitcoin's upward or downward trend on a price chart using trend lines. If the Bitcoin price stays above an upward trend line, it may suggest that it will continue to rise. On the other hand, if the price falls below a downward trend line, it may indicate a potential continued decrease. Price patterns. Technical analysis can also incorporate various price patterns, such as triangles, flags, or head and shoulders, to predict future price changes. For instance, the appearance of a head and shoulders pattern on a Bitcoin price chart might suggest a potential price drop. Technical indicators. Investors can utilize technical indicators like stochastic oscillator or RSI, Relative Strength Index, to gain a better understanding of the market situation. For example, if the RSI crosses the level of 70, it may indicate an overbought market, suggesting that Bitcoin's price could decrease. Of course, it's important to note that technical analysis does not provide 100% certainty regarding future price changes and should be regarded as a guideline. Arbitrage. Arbitrage involves buying and selling the same currency in different places to take advantage of price differences. In other words, if you buy a cryptocurrency at a lower price in one place and sell it at a higher price in another, you can make a profit. Example. If someone buys Bitcoin on exchange X for $2,000 and sells it on exchange Y for $2,050, they will earn $50 from this arbitrage. Attack 51%. The 51% attack poses a potential threat to some cryptocurrencies based on the proof of work system. This means that if one person or a group of people were to control 51% of the network's computational power, they would have control over the network and could carry out unauthorized transactions, such as reversing previous transactions or duplicating funds. Example. In August 2021, a 51% attack occurred on the cryptocurrency Ethereum Classic. The attackers, possessing 51% of the network's computational power, managed to carry out unauthorized transactions and steal over $1 million worth of ETC. This incident highlights the importance of ensuring that cryptocurrency networks are resilient against such attacks and underscores the significance of data security. All-time high. ATH stands for all-time high and refers to the highest price ever reached by a particular cryptocurrency in the market. This means that the cryptocurrency has achieved its best value in its history, and this value serves as a benchmark for comparison in the future. Example. In November 2021, Bitcoin reached its all-time high at almost $70,000. This marked a record level for BTC, and as of the writing of this ebook, its price has not surpassed this ATH yet. ATL. ATL, short for all-time low, refers to the lowest price ever reached by a particular cryptocurrency in the market. It stands in direct contrast to all-time high, which represents the highest price the cryptocurrency has ever attained. Understanding both ATL and ATH provides valuable insights into the price range and historical performance of a cryptocurrency. Example. In July 2013, Bitcoin hit its ATL at $68. Yes, I regret not buying it at that price too. Bag holder. A bag holder refers to a person who holds onto their investments in cryptocurrencies even as their prices plummet. The term is a play on words, combining hold and bag, implying that the person continues to hold their assets even if they become worthless. Example: I've been a bag holder of currency X for several months. When the price of currency X dropped by 95%, I decided to hold on to my assets because I believe that cryptocurrency prices are often volatile and the price of currency X will rise in the future. This often refers to holding on to projects that have failed and their value probably will never increase. Bearish. Bearish is a term used in the world of investments to describe a situation where someone expects asset prices to fall. A person with a bearish outlook is pessimistic about the market and believes that prices will decline in the near future. Example: Tom is a cryptocurrency investor and has a bearish outlook on the market. He believes that the prices of Bitcoin and other cryptocurrencies are already too high and will decrease in the near future. Because of this, Tom sells his assets and keeps the money aside, waiting for price drops to buy back in. BEP20. BEP20 is a token standard based on the Binance Smart Chain blockchain, used for creating and managing digital tokens on this platform. It's a type of token that can be utilized for various purposes, such as representing asset value, serving as a medium of exchange, participating in projects, and much more. Example: Company XYZ creates its own BEP20 token called Token XYZ, representing shares in the company. Investors interested in investing in the company can purchase Token XYZs on the Binance platform, enabling them to participate in the company's profits and growth. The token is also tradable on exchanges, providing investors with the opportunity to profit from its price fluctuations. BESA. BESA, or bear market, is a term used in finance, referring to a period during which the value of assets, such as stocks, bonds, or real estate, is declining. In other words, a bear market signifies falling prices in the financial market. Example: Calm in the stock market in 2008 was shattered when the global financial crisis led to a sharp decline in stock values on exchanges worldwide. Block size. Block size refers to the size of a block in a blockchain, the underlying network for some cryptocurrencies. It determines how much information can be stored in a single block and is a crucial element that affects the speed and efficiency of the network. Example: Bitcoin has a block size limit of 1 megabyte, meaning only 1 megabyte of information can be recorded in a single block. This limitation was introduced to reduce network congestion and prevent spam attacks. However, with the increasing demand for transactions, many in the crypto community believe this size is too small and needs to be increased to enhance the network's efficiency. Blockchain. Blockchain is a technology that enables the secure and immutable creation and storage of data. It consists of a network of records linked together in blocks, distributed across multiple users. Each block contains transaction information and is cryptographically secured, making it impossible to modify or delete without the knowledge of all network users. Blocks in the blockchain are interconnected in a chain-like manner. Each block contains transaction data from a specific moment and feedback information from the previous block in the form of a hash. A hash is a unique one-time string of characters generated based on the content of a specific block. Because each block contains feedback from the previous one, they are interlinked, forming a cohesive chain. If someone wanted to make a change in one of the blocks, they would have to make the change in all subsequent blocks, which is practically impossible. This interconnectivity ensures that the blockchain is secure and resistant to manipulation. Example: Blockchain technology finds applications across various fields and industries including finance. Blockchain can be used for creating and transmitting cryptocurrencies as well as recording and processing financial transactions. Supply chain management. Blockchain is employed for tracking and managing supply chains, ensuring transparency and reliability in the production and distribution processes. Healthcare. In the medical sector, blockchain records and processes patient data, ensuring the security and confidentiality of information. Energy. Blockchain is utilized for recording and trading renewable energy, such as solar and wind power. Government. Governments use blockchain for recording and processing official data, including elections and tax payments, ensuring security and transparency. These are just a few examples, but the applications of blockchain technology are vast and continually expanding. The Blockchain Explorer is a tool that allows browsing and analyzing data stored in the blockchain network. It enables tracking transactions, displaying address information, and providing detailed insights into blocks. Example: Etherscan is an example of a blockchain explorer. It's a tool specifically designed for browsing and analyzing the Ethereum network. It allows tracking transactions, addresses, and blocks, and also enables easy searching for information about smart contracts and tokens on this network. Etherscan is frequently used by developers, investors, and cryptocurrency enthusiasts to gain a comprehensive understanding of the Ethereum network's operations. BTD. BTD stands for Buy the Dip, which represents an investment strategy involving the purchase of assets, including cryptocurrencies, when their price is lower than before. The goal of this strategy is to buy assets at a lower price, potentially yielding higher profits in the future when the price of these assets rebounds to a higher level. This approach can be applied to various assets, including cryptocurrencies, stocks, commodities, and other financial instruments. Example: Investor X notices that the price of cryptocurrency ABC has dropped by 20% over the last week. According to his analysis, this cryptocurrency has future growth potential, and the current price declines are temporary. Therefore, Investor X decides to employ the buy the dip strategy and purchases as many units of cryptocurrency ABC as possible when it's at its lowest point. If his analysis is correct and the price of cryptocurrency ABC does indeed rise, Investor X will have the opportunity to profit from the investment. In online forums, this approach is often referred to as BTFD, which stands for Buy the F-Dip. Bug Bounty. A bug bounty program is where cryptocurrency creators offer monetary rewards or other benefits for finding and reporting bugs or vulnerabilities in their system's security. The aim is to ensure the security and stability of the network while encouraging collaboration and feedback from the community. Example: Company XYZ launches a new cryptocurrency and initiates a bug bounty program, offering rewards ranging from $500 to $500 for each reported and confirmed security flaw. Hackers and programmers from around the world inspect the code and report potential vulnerabilities, with rewards given for every identified and resolved issue. This approach allows Company XYZ to ensure the security of its cryptocurrency, fostering trust among its customers and investors. Build. In the world of cryptocurrencies, building refers to the creation of software or applications tailored for the cryptocurrency market. It involves a process where programmers and engineers develop and test software to ensure it functions correctly and meets user requirements. Example: Creating a cryptocurrency wallet is a build that ensures secure and user-friendly storage of cryptocurrencies. This process demands extensive knowledge and skills and is often associated with additional programs, such as the bounty program described earlier, to identify any application errors. Bullish. Bullish is a term used in the investment world to describe a situation where someone anticipates that asset prices, including cryptocurrencies, will rise. A person with a bullish outlook is optimistically inclined towards the market, believing that prices will increase in the near future. Example: Anna is a cryptocurrency investor with a bullish outlook on the market. She believes that the prices of Bitcoin and other cryptocurrencies are poised for growth and are likely to increase even further in the near future. Because of this, Anna buys more cryptocurrencies, expecting their prices to rise in the future. CBDC stands for Central Bank Digital Currency. It is a type of digital currency issued by a country's central bank and operates within its territory. CBDC serves as a virtual equivalent of physical money and aims to complement traditional forms of payment, eventually phasing out the money we know today and eliminating cash transactions. CBDC is typically based on blockchain technology or a similar system, ensuring the security and immutability of transactions. It can function in various ways, such as being stored in a digital wallet or a bank account. The key difference between CBDC and traditional forms of payment lies in its direct issuance by the central bank, bypassing commercial banks. CBDC offers potential benefits, such as faster and cheaper transactions. However, what's crucial for us as citizens are the risks associated with the widespread adoption of this payment method. Example: currently, many countries are conducting research and experiments regarding the introduction of their own central bank digital currency. Below are a few examples of countries that have already introduced or plan to introduce their digital currency. It is China, Bahrain, Tunisia, Sweden, Venezuela, and others. It's important to note that introducing CBDC is a complex process that requires further research and analysis. Therefore, many countries are still conducting research and experiments before making a decision on launching their digital currency. CFI is an acronym for Centralized Finance, referring to traditional central financial institutions such as banks, exchanges, and investment funds that operate based on centralized management structures controlling the flow of finances. In the context of cryptocurrencies and blockchain, the term CFI is used to differentiate traditional centralized financial institutions from decentralized finance, which operate on decentralized systems and smart contracts instead of centralized institutions. Within CFI, investors and users utilize services offered by central financial institutions, such as cryptocurrency exchanges, online wallets, and lending platforms for transactions and managing their funds. While CFI offers several advantages such as user-friendliness, stability, and security, it also comes with certain drawbacks, including increased control and dependency on central institutions, high fees, and limitations in accessibility. Example: in the context of cryptocurrencies, CFI refers to centralized cryptocurrency exchanges such as Binance, Coinbase, or Kraken. These platforms provide trading interfaces where users can trade cryptocurrencies using traditional fiat currencies or other cryptocurrencies. Other examples of CFI include online crypto wallets like Exodus or blockchain.com, enabling users to store their cryptocurrencies in centralized systems. These wallets also offer tools for portfolio management and transactions. All these examples provide users with easy access to cryptocurrency-related services. However, they are centralized, meaning they are controlled by a single institution or company. CX, centralized exchange, refers to a centralized marketplace. In the case of CX, all transactions occur through a central platform, acting as an intermediary between buyers and sellers. This exchange operates similarly to a traditional stock exchange, where investors can buy and sell company stocks. On CX, users can trade various popular cryptocurrencies such as Bitcoin, Ethereum, Litecoin, or Ripple. CX platforms offer several advantages, including fast transaction processing, user-friendly interfaces, and the security of funds ensured by various safety measures. However, they are centralized platforms, meaning there is a risk of the platform becoming a target for hacking attacks. Additionally, due to regulatory compliance, these platforms often impose restrictions on user accessibility, identity verification, and other aspects. In recent years, gaining popularity as an alternative to CEX are decentralized exchanges, where transactions occur directly between users without the involvement of a centralized platform. An example of a centralized exchange can be Binance, which allows buying-selling cryptocurrencies, has its own launchpad, futures trading options, and currently offers some of the lowest trading fees as of the writing of this ebook. By using the code BJ5AYQS when creating an account, you can take advantage of interesting promotions for new users. However, it's crucial to treat CEX exchanges like currency exchange offices. You shouldn't leave your funds there after the exchange. The safest way to store your assets is using hardware wallets, which I'll describe later in the book. Cloud mining. Cloud mining is the process of mining cryptocurrencies, where investors utilize services offered by companies providing computational power and necessary hardware for performing calculations required for cryptocurrency mining. In cloud mining, investors don't physically own or buy the hardware needed for mining cryptocurrencies. Instead, they rent computational power and mining capabilities from external providers. However, it's crucial to note that cloud mining services often come with costs and risks. These costs can stem from rental fees for computational power, as well as expenses related to hardware maintenance, such as electricity and cooling costs. Moreover, the risks associated with cloud mining can arise from cryptocurrency market instability, uncertainty about contract terms, and the quality of services offered by providers. Additionally, many companies offering such services turn out to be scams. Example. At this point, instead of providing an example, I want to emphasize once again the importance of being cautious. Not all cloud mining services are honest and reliable. Before choosing a cloud mining service, it's essential to thoroughly research the market, analyze costs, and read reviews from other users. Coin or token. The term coin refers to individual units of digital currencies. Each cryptocurrency has its own monetary unit, referred to as a coin or token. These terms are often used interchangeably, but they have slightly different meanings. A coin, or in loose translation, a currency, is a cryptocurrency that has its own independent blockchain and functions as a standalone payment system. On the other hand, a token is a digital unit issued on an existing blockchain, such as Ethereum or Binance Smart Chain. Tokens can represent various values, such as currencies, commodities, stocks, voting rights in decision-making systems. Unlike coins, tokens are not independent cryptocurrencies, but rather represent some value within an existing blockchain network. Depending on their functions, tokens can have different features, such as security, guarantees, voting rights, and dividend entitlements. Example. One of the most popular coins is Bitcoin, and another well-known cryptocurrency is Ethereum. These are called coins because they have their own blockchain. Examples of tokens include Tether and Uniswap. Cold wallet. A cold wallet is a type of cryptocurrency wallet that operates offline, meaning it is not connected to the internet. This is a safer solution compared to storing cryptocurrencies in a hot wallet, which is an online wallet connected to the internet and may be more vulnerable to hacker attacks. A cold wallet allows the storage of private keys, which are necessary for conducting cryptocurrency transactions and transfers. Because it is disconnected from the network, remote takeover of the wallet is impossible. Currently, this is the safest way to store your funds in the long term. An example of a cold wallet includes Ledger or Trezor. These are physical devices that store private keys on a special chip secured with a password. The wallet can be connected to a computer to conduct cryptocurrency transfers and then disconnected and stored offline. Remember to buy such hardware only from the manufacturer or an official distributor. You can be confident that your funds will remain secure as long as you take care of your private keys. A custodial wallet is a type of cryptocurrency wallet where the user entrusts control of their cryptographic assets to a third party, such as a cryptocurrency exchange or trading platform. In this case, the custodian is responsible for securely storing the private keys and managing the user's wallet. On the other hand, a non-custodial wallet is a wallet where the user has full control over their cryptocurrencies, and the private keys are stored solely by the user. In this scenario, the user can access their funds using a special seed phrase or password, eliminating the need to rely on other entities and allowing for independent wallet management. Custodial wallets might be more convenient for beginners as they don't have to manage private keys and the risk of losing them. However, non-custodial wallets offer greater privacy and security since the user is solely responsible for their funds and doesn't need to trust any third party. Example: a custodial wallet example is a cryptocurrency wallet available on a cryptocurrency exchange, such as Coinbase Wallet. In contrast, a non-custodial wallet example includes wallets like Exodus Wallet or Trust Wallet, where users have complete control over their own private keys and funds. dApps. dApps, short for decentralized applications, are applications that operate on blockchain or other decentralized infrastructures. In simpler terms, these are applications that leverage blockchain technology to achieve distribution and security. dApps differ from traditional applications in that they are decentralized, meaning they are not controlled by a single central institution or company. Instead, they run on multiple nodes within a blockchain network, ensuring their reliability, transparency, and resistance to censorship. Example: dApps can be applied in various fields, from finance and gaming to logistics and healthcare. Examples of popular dApps include Ethereum, MakerDAO, CryptoKitties, Augur, Golem, and many more. Day trading is a trading strategy that involves buying and selling assets such as stocks, currencies, cryptocurrencies, and others within the same day. The goal of day trading is to capitalize on short-term fluctuations in asset prices to make a profit. Trading financial assets always carries risks, and day trading is one of the most high-risk trading strategies because investors often make quick decisions based on short-term trends and price fluctuations. Day trading also requires extensive knowledge of markets and financial instruments, analytical skills, and good emotional control, as stress and time pressure can lead to impulsive decisions. An example of day trading is the buying and selling of stocks within a single day. An investor might buy shares of company A at the beginning of the day and then sell them a few hours later when the price rises. Alternatively, the investor could sell shares of company B early in the day and then buy them back a few hours later when the price drops. Both of these scenarios rely on exploiting short-term price movements to make a profit within a single day. Investors often use specialized tools such as technical indicators and fundamental analysis to assist them in making investment decisions. Dollar-cost averaging is an investment strategy that involves regularly investing fixed amounts in a particular financial instrument, regardless of its current market price. Through this method, the investor buys more assets when prices are low and fewer when prices are high, helping to mitigate the impact of price fluctuations on the overall investment outcome. DCA is considered a relatively safe and easy-to-use investment strategy. Example: if an investor decides to invest $100 each month in shares of company XYZ, regardless of the current price of the company's shares, they will buy as many shares as $100 allows. If the share price increases, they will buy fewer shares in the following month, and if the price decreases, they will buy more shares. Dead cat bounce is a term used in financial markets to describe a situation where the price of an asset briefly rises after a sharp decline, only to fall again. Example: let's imagine a scenario where a company announces poor financial results, causing a sharp drop in its stock price. After a while, there might be a brief revival in the market during which the stock price increases by a certain value. However, after a few days or weeks, the price starts falling again. This moment, when the price briefly rises and then falls again, is referred to as a dead cat bounce. DeFi, short for decentralized finance, refers to financial systems built on blockchain technology that enable transactions without the need for traditional financial intermediaries. This means that DeFi operates in a decentralized manner, without central points of control. An example of DeFi is the Uniswap platform, which allows direct cryptocurrency trading between users. Uniswap is built on the Ethereum blockchain and utilizes automated market makers responsible for price determination. Users on Uniswap can trade various tokens, with the platform charging only a small fee for transactions. All transactions on Uniswap are decentralized and occur without the involvement of financial institutions, enabling fast and cost-effective value transfers between users. The term Dagon is short for the English word degenerate, which in the context of cryptocurrencies refers to an investor who makes highly risky investment decisions without applying any strategy or analysis, often leading to financial losses. This term carries a negative connotation and is not typically used in a positive context. Example: in the world of cryptocurrencies, a dagon refers to someone who buys cryptocurrencies without market analysis, basing their investment decisions on assumptions or hunches. Another example of a dagon could be an investor who buys cryptocurrencies without safeguards against price drops, assuming that prices will always rise. Such an approach to investing is highly risky and can lead to significant financial losses. DEX is short for Decentralized Exchange, which refers to a decentralized cryptocurrency exchange platform. DEX allows users to buy and sell various cryptocurrencies directly with each other, eliminating the need for intermediaries or central financial institutions. DX platforms leverage blockchain technology, making the trading process more transparent and secure, giving investors greater control over their assets. One example of a DEX is Uniswap, which operates on the Ethereum blockchain. On Uniswap, users can directly exchange various cryptocurrencies with one another, and the price is automatically determined based on market demand and supply. DEX platforms like Uniswap are gaining popularity among investors looking to avoid centralized cryptocurrency exchanges, where issues related to security and control over their assets often arise. A DEX aggregator is a tool that allows investors to simultaneously access multiple decentralized cryptocurrency exchanges to get better prices or improved trading conditions. DEX aggregators automatically compare cryptocurrency prices and other trading parameters across various DX exchanges, presenting them in one place. This enables investors to find the best deals conveniently. One example of a DEX aggregator is 1inch Exchange, allowing users to trade cryptocurrencies across multiple DEX exchanges like Uniswap, SushiSwap, Balancer, and many more. Investors can select the cryptocurrencies they want to buy or sell, and 1inch automatically finds the best offer available on the accessible exchanges. DEX aggregators attract investors looking for the best trading conditions in the market, while avoiding the need to use multiple trading platforms and incurring high transaction costs. DIOS stands for the English phrase, "do your own research," which precisely means conduct your own research. In the context of cryptocurrencies, it signifies that investors should thoroughly investigate and analyze a project or cryptocurrency before making an investment decision. This is crucial because the cryptocurrency market is highly volatile, and projects and cryptocurrencies can vary widely in terms of risks and potential benefits. Example: an investor interested in purchasing a new cryptocurrency begins by reading the project's white paper, which outlines its goals, applications, and technology. They then explore websites, discussion forums, and social media platforms to gather more information about the project and insights from other investors. The investor might also conduct fundamental and technical analysis to assess the project's value and potential risks. Through research, investors become better prepared to make investment decisions, avoiding pitfalls and scams in the cryptocurrency world. Diversification is an investment strategy where an investor spreads their investments across various types of assets to reduce investment risk and increase the chances of potential gains. An example of diversification in cryptocurrencies could involve purchasing several different cryptocurrencies instead of focusing on just one, or investing in projects from various sectors such as finance, healthcare, gaming, metaverse, and so on. Diversification can also be achieved by spreading investments across cryptocurrencies, stocks, bonds, real estate, and other assets, reducing risk as the decline in the value of one asset won't significantly impact the entire portfolio. ERC20 is a technical standard for digital tokens based on Ethereum, which defines a set of rules and interfaces for smart contracts. Tokens based on the ERC20 standard are compatible with Ethereum wallets and other platforms that support this standard. An example of an ERC20 token is the UNI token, which is used in the Uniswap protocol, a decentralized exchange that allows the trading of ERC20 tokens directly from an Ethereum wallet. The UNI token is utilized for managing the Uniswap protocol, voting on proposed protocol changes, and sharing profits generated from transaction fees on the platform. Other popular ERC20 tokens include Tether, Link, and Ethereum. An exit scam is a financial fraud in which the developer of a cryptocurrency project or other online investment suddenly withdraws from the project, disappearing with the investor's funds. Such scams often aim to extort a large amount of money, and the developers are often untraceable or unable to be brought to justice later on. An example of an exit scam was the cryptocurrency project BitConnect, which was introduced to the market in 2016. The project promised high profits with low risk for investors who put their money into BitConnect coin and joined the project's affiliate system. In January 2018, the project developers unexpectedly announced the closure of the platform and withdrew from the project, leaving investors with lost funds. As a result, the price of BitConnect coin plummeted from $400 to less than $1 within a few days, causing losses for thousands of investors. A falling knife is a situation in which the price of a particular asset rapidly declines, and investors seeking to take advantage of the opportunity to buy at a lower price invest in it, but the price continues to drop. This is a highly risky situation because the price may keep falling, leading to investment losses. That's why it is said not to catch falling knives, meaning long red candles on charts, as you might get hurt. An example of catching falling knives can be a situation where the price of a particular cryptocurrency drops after the announcement of bad news regarding the project, such as delays in implementing new features, security issues, or changes in project operations that negatively impact the cryptocurrency's value. In such a scenario, investors might be inclined to buy the cryptocurrency at a lower price, but the price could continue to fall, resulting in a loss for the investment. It's important to note that a falling knife is a situation where investors make investment decisions based on a sudden price change, without proper investigation into the reasons for the decline and assessing the associated risks. Therefore, before making any investment decision, it's always crucial to thoroughly research the market situation and evaluate the risks associated with the investment. Fee or gas fee refers to the charge users pay for conducting transactions on the blockchain. This fee depends on the network congestion and is paid in a specific cryptocurrency. Using Ethereum as an example, a fee or gas fee is the charge users pay to perform transactions on the Ethereum network. These transactions can include sending Ether, executing smart contracts, and using DeFi applications. The fee is calculated in gas units, which reflect the amount of work required to process a specific transaction. The higher the gas value, the higher the transaction fee will be. For instance, if a user wants to send one Ether to another address, they have to pay the transaction fee. When the Ethereum network is heavily congested, the fee can be very high, and users might opt for a higher fee to have their transaction processed faster. Fiat currency is the official currency issued by governments and central banks of a country. The term refers to any currency that is not backed by any physical commodity like gold, but derives its value from the government's or central bank's authority. Examples of fiat currencies include the US dollar, euro, Japanese yen, British pound sterling, Polish zloty, and so on. These currencies are issued by respective governments and regulated by central banks to stabilize the economy and ensure financial liquidity. A flash crash is a sudden and rapid decline in the price of financial assets that occurs within a very short period. It can be triggered by various factors, such as sudden shifts in market sentiment, technical issues, or human errors. Typically, within a few minutes or hours, the asset prices return to their original levels, but this doesn't always happen. An example of a flash crash occurred in May 2010 when the stock market value plummeted by 9% within a few minutes, resulting in billions of dollars in losses. Another example could be the collapse of the Terra Luna project, whose value plummeted to practically zero within a few days in May 2022. FOMO is an abbreviation for fear of missing out, which refers to the emotions experienced by investors when they observe the rise in asset prices and fear missing out on the opportunity for profits. An example of FOMO could look like this. An investor hears about the rise in the price of a particular cryptocurrency and sees that its value is constantly increasing. Fearing missing out on the opportunity for profit, they decide to purchase this cryptocurrency, regardless of whether it is worth its price. This investor acts based on emotions rather than sound judgment and market analysis. FUD is an acronym for the English phrase fear, uncertainty, and doubt. In the context of cryptocurrencies, it refers to the spreading of negative information or rumors aimed at instilling fear, uncertainty, and doubt in people regarding a specific project or the entire market. An example can be reports about money laundering or other illegal activities related to a specific cryptocurrency, which in reality may be greatly exaggerated or unconfirmed. Another example can be speculations about potential regulations or bans that might cause the cryptocurrency's value to drop. Often, FUD is spread by individuals or groups aiming to manipulate the market or induce panic among investors to buy cryptocurrencies at lower prices. Google Authenticator is a free smartphone application created by Google that is used to generate one-time authentication codes for confirming a user's identity within two-factor authentication authorization. Two-factor authentication is an authentication process that requires the user to provide two types of information to confirm their identity, typically a password and a one-time code generated in real time. An example of using Google Authenticator in the two-factor authentication process could look like this. The user logs into their account by entering their username and password. The system requires the user to provide a one-time code generated by the Google Authenticator application on the user's smartphone. The user enters the code generated by the application to confirm their identity. Upon successful entry of the code, the user gains access to their account. GEM usually refers to a niche, lesser-known cryptocurrency that has the potential for future value growth. These are typically cryptocurrencies that are just starting to develop, do not yet have widespread popularity, but possess unique features or technological solutions that might attract more attention and investors in the future. An example of a cryptocurrency that turned out to be a gem is Chainlink. Chainlink is a platform that enables the connection of the real world with the blockchain, allowing the creation of smart contracts using external data. With the growth of DeFi, Chainlink gained popularity as essential infrastructure for DeFi applications, leading to a significant increase in its value. GitHub is an online platform for hosting and managing programming projects using the version control system Git. It allows developers to collaborate on projects, track changes in source code, and share source code publicly or privately. An example of GitHub's application is the popular programming library React, created by Facebook. React's source code is hosted on GitHub, where developers from all over the world can browse the code, report issues, contribute fixes, and collaborate on the project's development. As a result, React has become one of the most popular JavaScript frameworks in the world. A governance token is a cryptocurrency used for voting on decisions related to a project or blockchain protocol. Holders of governance tokens have influence over the project's development and can make decisions regarding the functioning of the protocol. An example of such a token is the graph, which is used to govern the graph protocol. GRT holders can vote on proposals for changes in the protocol, such as introducing new features or modifying rewards for delegators. Decisions are made by the community, and the more GRT one holds, the greater influence they have on the decisions. The Bitcoin halving is an event that occurs approximately every 4 years, reducing the rewards for miners by half. This means that for mining one block in the Bitcoin network, a miner receives less Bitcoin than before. The purpose of the Bitcoin halving is to control the amount of Bitcoin in circulation. By reducing the miner's reward every 4 years, the amount of Bitcoin that can be mined is limited. This, in turn, affects the stability and value of Bitcoin because the limited supply can lead to a price increase. Example: the first halving took place in 2012 when the mining reward decreased from 50 to 25 bitcoins. The second occurred in 2016, reducing the reward from 25 to 12.5 bitcoins. The most recent one happened in 2020, decreasing the reward from 12.5 to 6.25 bitcoins. The next one is scheduled for around April or May 2024. Hard cap refers to the maximum amount of funds that a cryptocurrency project aims to raise during an initial coin offering or another type of financial campaign. It means that the project team determines the maximum amount of money they want to obtain to develop their project, and once this limit is reached, no more funds will be collected. An example of a hard cap can be seen in the ICO campaign of the Golem Network project, which in 2016 raised 820,000 Ethereum, it's approximately $8.6 million, within 29 minutes from the start of the campaign, thus reaching its financial goals. This means that the project achieved its maximum amount and the remaining funds were returned to the investors. HODL is a slang term indicating a strategy of long-term holding of assets instead of short-term speculation and frequent transactions. The emergence of this term originated from a misspelling of the word hold in a post on a cryptocurrency forum, where a user stated that they would not sell their bitcoins despite sudden price drops. Example: there's no need to panic, just keep hodling and wait for further developments. HOSA, bull market, refers to a situation where the prices of financial assets are rising and investors are optimistic about future gains. However, it's essential to remember that a bull market doesn't last forever, and after a period of growth, there is often a price correction or decline. Therefore, it's crucial to exercise caution and avoid making overly risky investment decisions based on emotions. A significant skill is exiting a profitable position and securing profits before any downturns occur. One of the examples of a bull market in the cryptocurrency market was the period of price growth in late 2017. During that time, the prices of most cryptocurrencies, especially Bitcoin, sharply rose to record levels. In December 2017, the value of Bitcoin reached nearly $20,000 per unit, marking an approximately 20-fold increase within just 1 year. Similar upward trends were observed for other cryptocurrencies, indicating overall investor euphoria and the emergence of a cryptocurrency bull market. A hot wallet is a type of cryptocurrency wallet that is connected to the internet. This means that access to it is easy and fast, but it also comes with certain risks because the wallet is more vulnerable to hacker attacks. Example: MetaMask is a wallet that is an extension for web browsers such as Google Chrome and Firefox. It allows users to store, send, and receive various types of cryptocurrencies, including Ethereum and ERC20 tokens. MetaMask acts as an intermediary between the user and the blockchain, enabling easy and secure use of decentralized applications without the need to download special software. ICO stands for Initial Coin Offering, which literally means the first coin offering. It is a method of raising funds for the development of new cryptocurrency-related projects involving the initial sale of virtual tokens to investors in exchange for existing cryptocurrencies, typically Ethereum. Example: during the Ethereum ICO conducted in 2014, the platform raised 31,500 bitcoins, which was approximately $18.5 million at that time. The funds collected were used for the development and improvement of the Ethereum platform. Since then, ICOs have become a popular way to raise funds for new cryptocurrency-based projects. While it wasn't the first campaign, it attracted the most attention and is considered groundbreaking in the history of ICOs. Infinite mint attack is a type of attack associated with some DeFi protocols where an attacker can exploit a loophole in the code, allowing unlimited issuance of new tokens. This way, the attacker can create additional tokens and sell them in the market, leading to inflation and devaluation of existing tokens. An example of such an attack was the attack on the YAM Finance protocol in August 2020. As a result of the attack, the YAM token, which was gaining popularity as a elastic currency with a stable value, lost almost all its value within a few hours. The attackers managed to create a huge number of additional tokens, causing catastrophic inflation and devaluation of YAM to nearly zero. KYC, or Know Your Customer, is a process in the cryptocurrency industry where users are required to verify their identities. It's done to prevent fraud, money laundering, and other illicit activities. Users must provide personal information and documents to use cryptocurrency exchanges or participate in ICOs. Example: the KYC process must be completed by a user wanting to open an account on a cryptocurrency exchange. In this case, the user must provide identity documents, such as a passport or ID card, and then go through the identity verification process to confirm their personal information. Upon completion of the KYC process, the user has full access to the exchange's features, such as cryptocurrency trading and fund withdrawals. The term layer refers to additional layers of software or protocols that are applied on top of an existing blockchain network to enhance its performance or functionality. Different types of layers can be distinguished, depending on their functions and how they integrate with the main network. The most popular ones include Layer 1, the primary blockchain layer on which the entire network is built. It typically contains fundamental functions such as transaction processing and data verification. Examples of blockchain operating on Layer 1 include Bitcoin, Ethereum, and Cardano is Layer 2, an additional layer on top of Layer 1 blockchain, which can be used to enhance the network's performance, scalability, and functionality. For example, Lightning Network for Bitcoin and Polygon for Ethereum. Liquidity refers to the level at which assets can be bought or sold without significantly affecting their price. The higher the level of liquidity, the more likely buy or sell orders will be swiftly executed at the current market price. In the absence of liquidity, it means that a buy or sell order might impact the market price of the asset. Example: assets with high liquidity include currency pairs in the forex market, shares of large companies listed on the stock exchange, and some cryptocurrencies that are readily available on exchanges and in high demand. On the other hand, assets with low liquidity may include niche cryptocurrencies, small companies listed on the stock exchange, or high-value real estate properties, the sale of which can be difficult and time-consuming. A long position is a term used in the financial market, indicating that an investor buys a financial instrument anticipating its value to rise. The investor relies on the asset's price increasing, enabling them to sell it at a higher price, thus making a profit. An example of a long position can be illustrated by an investor who bought shares of company XYZ for $100, anticipating that their value would increase in the near future. In this case, the investor opens a long position, and when the stock price indeed rises to $120, they can sell the shares and make a profit of $20 per share. Market cap refers to the market capitalization of a specific cryptocurrency, which is the total value of all its units available in the market multiplied by the current price. This means that the market cap depends on both the number of units of the cryptocurrency and their market value. Example: if the number of issued bitcoins at a given moment is 19.2 million and the current market price is $30,000, the market capitalization of Bitcoin is approximately $576 billion, 19.2 million multiplied by $30,000 USD. However, it's important to note that market capitalization can fluctuate over time based on changes in price and the number of issued units of the cryptocurrency. A masternode is a specialized type of network node that meets specific technical requirements and stores a full copy of a cryptocurrency's blockchain. Masternodes play a crucial role in the cryptocurrency network, aiding in its security and efficiency. To set up a masternode, an investor typically needs to meet certain requirements, including owning a minimum amount of the cryptocurrency and demonstrating technical proficiency. The masternode must be operational at all times to properly support the network. In return for maintaining the network node, the investor receives a portion of transaction fees and block rewards. Example: the cryptocurrency that utilizes masternodes is Dash. In the Dash network, masternodes play a significant role in enabling instant send, fast transactions, and private send. Dash masternodes also influence decisions regarding the project's development, meaning that masternode owners have some influence over the cryptocurrency's direction. Memecoin is a cryptocurrency that typically lacks serious or practical applications, with its value often based on internet memes or jokes. These coins usually have low market capitalization and high price volatility. One of the many memecoins is Dogecoin, which was created in 2013 as a mere joke. However, in recent years, it has gained popularity and value, especially after Elon Musk began mentioning it frequently on Twitter. Dogecoin holds an iconic status due to its logo featuring a Japanese Shiba Inu dog and internet memes associated with this breed. Metaverse is a term that describes a virtual world that combines virtual reality and the physical world. It is an online space where users can create, share, and interact with virtual content, including games, applications, virtual products, and other items. Example: Decentraland is a decentralized platform that enables users to create, share, and experience fully blockchain-based virtual content on the Ethereum network. Mining reward refers to the amount of cryptocurrency received by an individual or group of individuals, known as miners, who successfully mine a block of transactions in a blockchain network. This reward is often given in the form of new units of the cryptocurrency, which are generated as a result of mining the block. The mining reward plays a crucial role in the cryptocurrency mining process, as it provides an incentive for users to participate in the process and maintain the blockchain network. Example: mining reward, as illustrated by Bitcoin, rewards miners with 6.25 BTC when they successfully mine a block. Previously, the reward was higher, at 50 BTC per block. However, Approximately every 210,000 blocks, about every 4 years, a halving event occurs, reducing the reward by half. The last halving took place in May 2020, and the next one is scheduled for 2024. This mechanism ensures a controlled issuance of new bitcoins, contributing to the cryptocurrency's scarcity and value over time. Mining pool can be translated as mining cooperative. It functions as a virtual cooperative where miners with their own mining rigs can join forces. The combined computational power of the entire pool is then used to mine a specific cryptocurrency. The coins mined are distributed among participants based on their individual computational power. Joining a mining pool allows miners to collectively increase their chances of successfully mining new blocks and earning rewards. Example: Slush Pool is one of the oldest and largest mining pools in the world. Established in 2010, it allows miners to combine their computational power to mine cryptocurrencies. Miners joining this pool collaborate in solving mathematical problems crucial for the block mining process. When the pool successfully mines a new block, the rewards are distributed proportionally among participants based on their contribution to solving the mathematical problems. Slush Pool is renowned for its reliability and fair distribution of rewards among its participants. Moonbag is a colloquial term referring to an investment portfolio intentionally holding onto a portion of a cryptocurrency that has been deliberately retained after a sale. The purpose is to wait for a potential future price increase, enabling a profitable resale. It symbolizes the strategic approach of investors, akin to holding onto a lunar bag of valuable assets, anticipating the right moment to capitalize on the market's upward momentum. Example: Moonbag refers to an investment portfolio holding substantial amounts of popular cryptocurrencies like Bitcoin or Ethereum, alongside a few lesser-known projects with potential for future price growth. Investors maintaining a moonbag typically adopt a long-term investment strategy and are willing to take on the risk of potential loss in the entire portfolio's value. This approach reflects their confidence in the selected asset's future growth, aiming to capitalize on their increasing value over time. NFT, non-fungible token, is a type of digital asset that is unique and indivisible. This means it cannot be exchanged for another asset of the same value because there is no identical copy. Some potential applications of NFTs include ownership of digital assets and collections, integration with video games, support for artists and content creators, supporting charitable causes, virtual real estate. However, it's essential to note that these possibilities are speculative, and the actual applications of NFTs in the future may vary or change depending on technological advancements and market developments. Example: CryptoKitties is a game created on the Ethereum blockchain where players can buy, sell, and breed digital cats as NFTs. Each cat has a unique appearance and attributes, recorded on the blockchain as an NFT, ensuring their uniqueness and indivisibility. Players can trade their CryptoKitties on a specialized blockchain-based exchange, and some of these virtual cats reach remarkably high prices. The term no coiner refers to a person who does not own any cryptocurrencies. This term is commonly used by cryptocurrency holders to describe individuals who are skeptical or distrustful of blockchain technology and cryptocurrencies. An example of a no-coiner could be someone who believes that cryptocurrencies are a scam or a financial pyramid scheme, and therefore chooses not to invest their money in them. On-chain data refers to any information recorded directly on the blockchain of a specific cryptocurrency or blockchain network. It is an integral part of the blockchain network and is used for transaction verification, fraud detection, block generation, as well as for conducting analyses and generating statistics related to the network and its users. Since on-chain data is public, every blockchain network user can trace and examine it, constituting a crucial element of transparency and verifiability within the network. Example: On-chain data includes information about transactions, wallet addresses, the quantity of cryptocurrencies stored at each address, block times, and other details stored directly within the blockchain network. Special tools and websites such as Etherscan for Ethereum, blockchain.info for Bitcoin, or BSC Scan for Binance Smart Chain allow users to track on-chain data. These platforms provide transparency and insight into the network's activities, allowing users to explore various aspects of blockchain transactions and addresses. Paper wallets used for storing digital currencies, are typically software programs that facilitate blockchain updates during transactions. Paper wallets differ from so-called hot wallets as they operate offline, without internet access. Cryptocurrency users wanting to store their assets in a paper wallet usually print the private key on a sheet of paper. Paper wallets were particularly popular in the early years after Bitcoin's inception. Nowadays, cryptocurrency users tend to employ different methods for storing their assets, such as hardware wallets like Ledger or Trezor. Example: a paper wallet is an early form of cryptocurrency storage consisting of a printed private key that grants access to funds. This method was prevalent in the early stages of Bitcoin's network development. Passive income refers to a type of earnings that is generated without the need for active work. It means that an individual receiving passive income doesn't have to engage in physical or mental labor to earn money during a specific period. Example: renting properties. Property owners, such as apartments, houses, or offices, can lease their spaces and earn income from rent. Dividends. Someone owning company stocks can receive dividends from the company's profits. Investing in bonds. Investors purchasing bonds receive income in the form of regular interest payments. Intellectual property ownership. Individuals owning copyrights, patents, or trademarks can earn income by licensing these rights to other companies. Creating content on YouTube. Those creating popular YouTube videos can earn from advertisements displayed before or during their materials. Peer-to-peer is a communication and data exchange model between computers without the need for a central server. In a peer-to-peer network, each node or computer operates as an equal partner, capable of both downloading and uploading data simultaneously. An example of P2P is the Bitcoin network, where transactions are directly transmitted between users without the need for financial institutions as intermediaries. In the Bitcoin network, each node acts as an equal part of the network and has access to the complete transaction history, enabling verification of transaction accuracy. A phishing attack is a type of cyber attack that involves online scams aimed at extracting confidential information such as passwords, credit card numbers, personal data, and other sensitive details. Phishers create fake websites, emails, or text messages that closely resemble real websites and messages, deceiving users into divulging sensitive information. An example of a phishing attack is an attempt to deceive users through seemingly trustworthy emails, often impersonating reputable entities like banks or internet companies, requesting confirmation of personal information or credit card numbers. Proof of stake is one of the consensus algorithms employed in cryptocurrency blockchains, enabling transaction verification and block creation within the network. In the POS algorithm, instead of relying on computational power as in proof of work, network nodes use their cryptocurrencies as stakes to be chosen for block generation and receive rewards. POS was designed to address issues related to costs and energy consumption associated with proof of work. It is more economical and environmentally friendly, requiring less computational power and specialized hardware than POW. An example of a cryptocurrency utilizing the POS algorithm is Ethereum in its 2.0 version. In the POS algorithm, stakers need to lock up their cryptocurrencies as collateral to be selected for block generation and receive rewards. The longer stakers hold their cryptocurrencies as collateral, the higher their chances of obtaining a reward. Proof of work is one of the consensus algorithms employed in the cryptocurrency blockchain, enabling transaction verification and new block creation. In POW, network nodes compete to solve intricate mathematical problems, validating transactions and forming new blocks. The node that first solves the mathematical problem is rewarded with cryptocurrency and transaction fees. Individuals participating in this problem-solving process are called miners, and the process itself is known as mining. POW demands substantial computational power and specialized hardware, consuming significant energy to secure the network. In the cryptocurrency world, there's a playful term for traditional employment, mining fiats, referring to the concept of proving one's work in the traditional job market. Example: the POW algorithm is utilized by cryptocurrencies like Bitcoin. In the Bitcoin network, miners employ specialized hardware, known as mining rigs, to solve complex mathematical problems, validating transactions, and creating new blocks. The computational power and hardware requirements are extremely high, making Bitcoin mining a costly endeavor that demands significant financial investment. The private key is a string of characters used to unlock and sign cryptocurrency transactions. It is a fundamental security element protecting the funds stored in a cryptocurrency wallet, as it grants access only to the owner. It's crucial to keep the private key secure, preferably encrypted and away from third parties' reach. There's a saying, rightfully emphasized, that if it's not your keys, it's not your crypto. Hence, under no circumstances should anyone share their private keys. In the case of a Bitcoin wallet, a private key could look something like this. Remember, never to share your private key with anyone. If someone obtains it, they will have access to your funds from anywhere on Earth. Pump and dump is a financial fraud strategy where groups manipulate the price of assets such as stocks or cryptocurrencies by aggressively promoting them on social media and other communication channels to drive up the price. Then, when the price rises and investors buy these assets, the fraudsters sell their positions, causing a sudden price drop and leaving investors with significant financial losses. An example of pump and dump in cryptocurrencies was the case of BitConnect, which was heavily promoted by individuals on social media platforms as the best investment and a way to get rich quickly. BitConnect prices skyrocketed, and investors bought into the cryptocurrency, expecting further gains. However, in January 2018, BitConnect was forced to shut down, experiencing a 99.9% loss within just a few days, and investors lost significant amounts of money. It turned out BitConnect was a Ponzi scheme, and investors fell victim to a pump and dump fraud. Wrecked is a slang term referring to significant financial losses resulting from investments. The expression is derived from the English word wrecked, meaning damaged, demolished, or wrecked. Example: I bought XYZ at its peak and now the price has dropped by 95%. I am wrecked. A roadmap is a document or action plan that outlines the goals and direction of a project, company, or organization for the future. It typically includes a list of projects, features, and timelines to be realized. Example: in Ethereum's roadmap, future goals and directions for Ethereum's technology development are defined. This allows investors and developers to track the project's progress and understand the direction in which the development of this cryptocurrency is heading. Return on investment measures the efficiency of an investment by determining how much profit it generates in relation to its costs. ROI is typically expressed as a percentage and is calculated as the ratio of profit to investment costs multiplied by 100. ROI is a valuable tool for investors looking to gauge the effectiveness of their investments and compare various investment opportunities. The higher the ROI, the more efficient the investment, leading to greater profits in relation to costs. Example: imagine an investor bought cryptocurrencies for $1,000 and after some time, their portfolio grew in value to $2,000. In this scenario, the return on investment would be 100%. This signifies that the investment yielded a 100% return compared to the initial costs. Rollup is a scalability solution for blockchain networks that enables the compression of multiple smaller transactions into a single, larger transaction. Specifically, many smaller transactions are grouped together and processed off the main blockchain in a layer called rollup. Then, only the final state of these transactions is recorded on the main chain, saving space and improving efficiency. Example. One of the applications of rollups is in Ethereum, where various rollup projects such as Optimism, Arbitrum, and ZK exist. These projects implement rollups to accelerate transaction processing and reduce costs. Thanks to rollups, users can engage in decentralized finance activities on Ethereum without the need to pay high transaction fees and without compromising the network's security. SAFU is a term originating from the cryptocurrency community and is used as an acronym for the phrase "funds are safe," indicating that the assets stored in a particular system are secure and protected against various threats such as hacking attacks, technical glitches, fraud, or other unforeseen events. SAFU gained significant popularity after the cryptocurrency exchange. Binance announced the establishment of the Secure Asset Fund for Users, designed to safeguard users' funds in case of security incidents. However, beyond this specific initiative, the term SAFU is generally employed as a symbol of security and assurance for users across various cryptocurrency systems. Example. Let's imagine that the Binance exchange is targeted by hackers who steal cryptocurrencies from users' wallets. Thanks to the existence of the SAFU fund, Binance can swiftly cover users' losses and return their missing funds. Naturally, in such a situation, the exchange also takes other measures to secure users' wallets and prevent similar incidents in the future. Satoshi is the smallest unit of Bitcoin, named in honor of the creator of Bitcoin, who used the pseudonym Satoshi Nakamoto. One Satoshi is equal to 0.00000001 part of a Bitcoin. Satoshi is used to accurately represent the value of small transactions made in BTC. Since the price of Bitcoin is quoted in relation to the dollar or other currencies, for very low transaction values, using whole Bitcoin units becomes impractical. Hence, Satoshis are employed, enabling transactions of values less than 1 BTC. Example. If you want to buy a coffee for $3.50 in a store that accepts Bitcoin payments, you'll need to pay the equivalent amount in Satoshis. At the time of writing, the value of 1 Satoshi is around $0.000246, which means you'll need to pay around 14 for your coffee. A scammer is an individual who operates with the intent to deceive others for financial gain or other benefits. This can be someone online using various fraudulent techniques, such as phishing, to obtain confidential information or extort money from others. Example. The scammer reaches out to other users on social media platforms or online games, offering them a once-in-a-lifetime opportunity, such as promising small investments that will yield huge profits. In reality, this person operates to extort money from their victims or gain access to their personal data, which they can then exploit for criminal purposes. A seed is a string of random words used to recover a cryptocurrency wallet in case it is deleted or lost. The seed typically consists of 12, 18, or 24 words, which, when entered into a new wallet interface, allow the user to regain access to the funds stored on it. An example of a seed could be the string of words cat, dog, bird, fish, mouse, rabbit, turtle, lion, elephant, kangaroo, zebra, monkey. This kind of seed consists of 12 words and could be used to recover a lost cryptocurrency wallet due to hardware failure or damaged hard drive. It's crucial to store the seed in a secure location, such as a safe or on a written piece of paper, to avoid theft or accidental destruction. Never share your seed phrase with anyone. Shilling is the practice of promoting a cryptocurrency or any other product to increase its popularity or price, usually through false or exaggerated claims or opinions. Shilling is considered unethical and illegal because it misleads people and can lead to significant financial losses. An example of shilling could be a situation where someone on an online forum claims that a particular cryptocurrency is very promising and recommends it to other investors. However, in reality, this person may have a connection to the company or project behind that cryptocurrency and could be attempting to manipulate public opinion to increase the cryptocurrency's price. Such a practice contradicts the principles of fair investing and can lead to serious legal consequences. Short selling, a practice commonly used in stock and cryptocurrency trading, refers to the act of selling assets that the seller doesn't actually own. The goal is to buy back these assets in the future at a reduced price, thereby securing a profit. Essentially, it's a wager on the expected decrease in the value of a particular asset. Example: in the world of cryptocurrencies, short selling involves selling a cryptocurrency that one does not own, with the intention of buying it back in the future at a lower price. For instance, an investor may short Bitcoin by selling it at $50,000 and then repurchasing it when the price drops to $40,000. It's important to note that short selling is a high-risk investment strategy since asset prices might rise instead of falling, resulting in losses for the investor and what's known as a position liquidation. A smart contract is a computer program written in a programming language that enables the creation and enforcement of agreements between two or more parties in a decentralized, automatic, and intermediary-free manner. Smart contracts are utilized in various projects based on blockchain technology, and their distinctive feature is that once created and deployed, they operate in a decentralized and human-independent manner. An example of a smart contract could be an insurance policy that is created and enforced on the blockchain. In this case, if an event covered by the policy occurs, such as a car accident, the smart contract automatically pays compensation based on the specified conditions of the agreement. A stablecoin is a type of cryptocurrency designed to maintain a stable value relative to a specified asset, such as the US dollar or euro. In principle, the issuer should have a corresponding reserve of each token in the fiat currency it represents. A prime example of a stablecoin is Tether, which is pegged to the US dollar and aims to maintain a value of $1. Another example is USD Coin, also pegged to the US dollar and designed to maintain a value of $1. It's crucial to bear in mind that while stablecoins are widely used in the cryptocurrency world, each of them has its issuer, who might be subject to regulations. In the case of some stablecoins, there are risks associated with issuance and redistribution. Therefore, diversification is key when utilizing stablecoins. It helps minimize the risk linked to the insolvency of a single issuer and prevents a situation where the value of a cryptocurrency portfolio relies solely on one type of stablecoin. Algorithmic stablecoins utilize a special algorithm that autonomously adjusts the supply to maintain a stable value. In the case of algorithm-based stablecoins, the reserve could be another cryptocurrency. An example of an algorithmic stablecoin is Frax, which is based on an algorithm that adjusts its supply based on market demand fluctuations. When demand increases, the algorithm increases the supply, and when demand decreases, it decreases the supply to maintain a stable price. Staking is the process of locking a certain amount of cryptocurrency as collateral in a proof-of-stake blockchain network to secure the network and receive rewards for maintaining it. Users who lock their cryptocurrency as a deposit receive rewards in the form of new tokens or transaction fees. Example: Cosmos Atom is an example of a cryptocurrency that utilizes staking as a way to secure its network. In the Cosmos network, there are two types of staking: delegator staking and validator staking. Delegator staking allows users to delegate their ATOM tokens to validators, who are responsible for validating transactions and blocks. In return, users receive a portion of the validator's rewards in the form of new ATOM tokens. Validator staking enables users with a significant amount of ATOM tokens to run their own validating node, allowing them to directly participate in validating blocks and transactions on the Cosmos network. In return, users receive rewards in the form of new ATOM tokens as compensation for their contribution to securing the network. Testnet is a separate version of a blockchain that allows developers and users to test new features, applications, and protocols without using real cryptocurrency tokens. It enables testing of various scenarios without the risk of losing real funds. Rinkeby is a test Ethereum network based on proof of authority, meaning that the network nodes are managed by trusted operators. It's a popular choice among Ethereum developers looking to test and deploy their applications before they go live on the Ethereum mainnet. Rinkeby offers various tools, such as block explorers, for reviewing transactions and network status. Access to Rinkeby is open, and Test Ethereum can be obtained for free through various channels, such as faucets. To the moon is a popular phrase that signifies a rapid increase in the value of a particular cryptocurrency or investment, indicating a sharp upward trajectory. It's a metaphorical way of suggesting that the price is soaring towards the moon. Another to the moon moment occurred with the rapid rise of Dogecoin in May 2021. Within just a few days, the price of Dogecoin increased by over 100 times, reaching a level of 0.7 USD. All of this was thanks to the efforts of the community on social media platforms such as Reddit and Twitter, who began to pump the price of the cryptocurrency. Many people believed in Dogecoin and its potential for even greater value, causing the price of the cryptocurrency to skyrocket. Burning tokens, also known as token burning, is the process of permanently removing a portion of tokens from circulation to decrease their quantity in the market and increase the value of the remaining tokens. Burning can be applied for various reasons, such as limiting the supply, encouraging further investments in the project, or maintaining the stability of token values. Tokens are burned by sending them to an address without a private key, making it impossible to reuse them. This practice helps shape the token economy and can enhance the perceived value of the remaining tokens in circulation. Example: Binance regularly conducts token burns, reducing the circulating supply and increasing the value of the remaining tokens. In 2021, Binance burned over 5 million BNB, equivalent to approximately $1.6 billion. This strategic move not only impacts the market dynamics, but also reflects Binance's commitment to enhancing the value of its native token, BNB. In cryptocurrencies, the term whale refers to an individual or entity holding substantial amounts of a specific cryptocurrency. Whales have the power to influence cryptocurrency prices significantly due to the sheer size of their transactions, which can cause substantial market fluctuations. Example: let's consider a whale owning 10% of the total supply of a specific cryptocurrency, valued at $10 million. If this whale decides to sell their entire cryptocurrency holdings, it would increase the supply in the market, leading to a decrease in prices. On the contrary, if the same whale decides to buy more of the cryptocurrency, it would boost demand in the market, causing prices to rise. A white paper is a document that provides detailed information about a project, usually related to a new cryptocurrency or blockchain technology. It may include information about the project's goals, implementation methods, business model, technical aspects, and the cryptocurrency's economy. An example of a white paper is the original document describing Bitcoin, written by Satoshi Nakamoto in 2008. This document outlines the fundamental principles of blockchain technology, including how Bitcoin cryptocurrency operates, the cryptographic protocols used to secure transactions, and the functioning of the peer-to-peer network. The white paper serves as a foundational source of information about Bitcoin and has inspired numerous other blockchain projects. Thank you for your time spent with this audiobook. I hope I managed to clarify many concepts and aid in understanding complicated topics, enabling you to feel more confident in industry discussions. Good luck!